Today, I want to talk about what are current real estate interest rates. This seems to be a moving target, but by the end of this video, I'm going to outline current real estate interest rates and how you can use them for your advantage. Have you ever wondered how interest rates in real estate affect real estate investors? Are you curious about how some seasoned real estate investors are never affected by rising interest rates? Let's dive into this topic by first explaining what real estate interest rates are and what that means. Then I want to discuss how interest rates affect the economy. And finally, talk about the current real estate investment rate and what that means to you as an investor. If you're ready, let's go. In real estate, interest rate refers to the percentage a borrower pays the bank when they're loaning money from a bank. And it is the cost of borrowing money to purchase a piece of property. And that interest rate directly impacts the monthly payment every single month. A higher interest rate almost always means a higher monthly payment. So here are some key points about interest rates when it comes to real estate. Number one, it impacts affordability. A higher interest rate makes a home less affordable as it increases the total cost of the loan over time. The second thing about interest rate is it is determined by market factors. Interest rates are always influenced by the overall economic condition, including inflation, and are always set by the lenders based off of the consumer's credit score. And when it comes to interest rate, there's usually two types. There's fixed interest rate and variable interest rate. Mortgages can have a fixed interest rate, which means that it stays that percentage over the time of the loan, or a variable interest rate that fluctuates based on market conditions, meaning that the interest rate is going to go up or down depending on what current interest rates are at for the market at the moment. So here's how it works. When you take out a mortgage, that interest rate is calculated into the payment to determine how much you owe every single month. And then obviously you have your mortgage payment. Your mortgage payment consists of principal and interest, but typically most home loans are front loaded, meaning that your mortgage payment initially when you first buy a home, you're paying a lot more in interest than you are in principal pay down. As you get closer to the end of your loan, you're paying less in interest and more towards principal. Now this can be kind of tricky in such a sense that a lot of people refinance their home because of a lower interest rate, say 5 years into a loan. All the money they've paid up to that 5 years has been paid towards interest versus principal. So they've paid down very little in principal on their home, but paid a ton towards interest. Here's another thing to consider when it comes to interest rates. When it comes to interest rates, because your loan's typically a 15 or 30-year mortgage, the amount that you pay in interest over the life of your loan can sometimes be hundreds of thousands of dollars, might even equal the amount you've paid for your home in the first place. And that's why interest rates can be so interesting when you're looking at purchasing a piece of property. And there's really a couple things to consider. Number one, what is the current interest rate right now? But number two is what percentage of return on your investment can you make regardless of the interest rate? Because if you look at a piece of property, let's say that I bought a home near Orlando, Florida, close to Disney World, and it was a short-term rental. And interest rate was low, but even if interest rate was higher, because of the gross annual income that comes in from that home, I'm making about a 20-25% cash on cash return on that property. So even if interest rate was higher, I still might be making, say, 15, 16, 17%. So if you find an asset that is producing the type of income or return on investment, interest rates might not factor in as much as if you're owning the home yourself, not being a real estate investor. Or in some scenarios, people who are flipping properties don't care too much about the interest rate because they know within, say, 6 to 12 months, they're turning that property and receiving a lump sum of cash rather than relying on rental income to make all their payments. So how do interest rates affect the economy? Well, in a lot of ways. If interest rates are high, there are a lot of people that are a little bit more nervous to jump in and buy a piece of property because they know that they're going to pay a larger mortgage payment every single month, which limits the money they can spend on other things like goods and foods and services, or even on discretionary expenses like vacations or things like that. So it definitely affects the mindset of investors, even homeowners, when interest rates are high. Here's one thing to note though, is like we've been spoiled for such a long time with interest rates being so low, below 3% for a period of time, but definitely below 4% for a longer period of time, that interest rates being at 6.5% right now is something that seems extremely high because we've been spoiled with such low interest rates. Another thing with interest rates, with them being high, less people buying homes, it means that the demand is lower. And when demand is lower on properties or in any type of real estate market, typically home prices start to come down. Now, we haven't seen a lot of that yet because inventory is still fairly low, because when supply is high, prices will also come down. When demand is high, obviously prices go up. And so there's a lot of factors to consider when you're looking at interest rates and how it affects people's sentiment for wanting to buy, the demand or the low demand or the supply of homes. Currently today, December 18th, 2024, interest rates are about 6.48% on a 30-year fixed and 5.85 on a 15-year fixed mortgage. If you contrast that to where we were 3.5 years ago with some interest rates below 3%, that is almost double. So somebody who was looking to buy a $300,000 home, say 3.5 years ago, might have paid half in their mortgage payment of what they'd be paying today. So what if there was a strategy of investing in real estate that did not matter what the interest rate was? And I've actually come up with that strategy. I'm currently doing it right now. It's a strategy that I've come up with, that I've coined the phrase and call cash flow flipping. It's an amazing strategy that works in any market condition, and it works for a beginner or an advanced real estate investor. And I can show you exactly how to do this strategy to create great cash flow every month, but also to build wealth regardless of what the current interest rate is. And you can go ahead and click on this full video below, Cash Flow Flipping, where I go into great detail. Thanks for stopping by. Have an amazing day.